Okay, folks, this is the first time I've spoken to a group in Canada, although I have spoken all over the world. I've been around almost forever, uh, 40 years, and it's gone by fast. The only thing that moves faster is a market when it's moving against you. Most times we sit there, we do our work, we're taking a chance. Every trade is a risk, but it seems to move a little quicker when it's moving against you. So we have to learn risk and patience and have a methodology. And I've lectured for almost just about taught my course for 30 years, but I've been working with individuals and everything for 35 or 40. I was very fortunate to find the RSI and started reading on that. And I ended up meeting Wells Wilder about 10 years, 12 years later. He said, "You went a lot further with this than I ever did." And I said, well, each time I saw something, doing the charts by hand, and you're looking at graph paper, and you're plotting just that one value every day for the RSI. I was doing about 15 different markets when I started. And every day, soybeans and gold and cattle. And I didn't really get into the stocks till later. But it was funny because I didn't get a computer until 88. We had the crash in 87. And I had started with a small brokerage firm, and we'd have the morning meetings, and I would sit there and sometimes I'd write something down they said. But the boss noticed I was making a list of phone calls of who I had to call. I really wasn't paying attention to the meeting. And he asked me after it was over, why aren't you taking any of the house recommendations? I said, because I don't agree with a lot of them. I'm doing my own work. And he said, well, that's not right. Well, needless to say, I only lasted another couple of weeks. And I thanked him when I left. I shook his hand and I said, thank you. He said, for what? I'm firing you or asking you to leave. We won't use the word fire. And I said, no, you realized, or you helped me to realize this is not where I want to be. I want to do my own work. I've always been independent. And I found something I studied and worked with. And I was there almost 3 years. But every afternoon, I just waited for the close and updated all my charts. And the guys in the office started asking me, you going to buy that cattle trade? I said, no. And I'm going to show you today a few things with the, get my PowerPoint up there. Okay, wait a minute. It's not there. All right, PowerPoint. This is why I said I'm a real technotard. Where's the one I sent you, Greg? Okay, let's do it this way. I do know this. When I get lost.
Yeah, what if you just open PowerPoint and then, or
no, that would probably, all right, here's PowerPoint slides. Okay. Trading with the RSI edge.
That's the one.
This is a comment, came from a commercial. Reebok. All men are created equal. Some just work harder in the preseason. And I figure my preseason was those 10 years where I worked just with the RSI chart and waited for the close and calculated the numbers by hand. That was my preseason. I didn't have a computer until after the 87 crash and spoke at my first conference in 88 for CompuTrack in Boston. And what that taught me was to not so much to rely on one indicator. I mean, I had friends that were using candlestick charts and Elliott wave. And the thing with Elliott wave, no disrespect, but I always found that I asked 10 people what their interpretation or what their view was on a market, and I got 10 different answers, or at least maybe 4 that agreed. The other 6 were all different. And I realized biases. And I will also recommend not only my work, but Mark Douglas's work. And Mark and I became good friends. His book, The Disciplined Trader, if you don't have that on your shelf, you need to order it today. his understanding of psychology. But what I was saying about not using one indicator, the thing I'm going to share with you is the term I used for what type of analysis I do. And I told people I call it primotus: price, momentum, time, and sentiment. And I've only seen one indicator that can give me all four. I do work with time cycles and count how many weeks apart from low to high, low to low. I have friends that know Elliot. I taught myself candlesticks by every time I saw something in the RSI, I flipped my bar chart to a candle and look at the candlesticks. But I know Steve Nissen, Steve Bigelow, most of the guys that have been around forever, some who we've lost, I was sorry to say, have passed away. But I always found the RSI could show you which way the price was going, what the trend was, and identify the trend, recognize and identify trend change, but also be able to forecast targets in the direction of the new trend that's about to emerge. So I had price analysis, trend analysis, and price targeting. So I want to do this almost backwards. I'm going to go to the last chart in the slides, and then we'll come forward, and then we'll look at a few things. I was going to call the pharmacy and or call my doctor and ask my doctor to send Greg a sedative, because he kept saying he's so, I'm a little bit nervous. I'm hearing the word nervous from people who've been around for a while. They're not caught up in the euphoria, or what was it Greenspan called it, irrational exuberance. I'm feeling the same way you are, Greg, and a lot of people I know and respect. This is getting a little frothy. But I wanted to share this last chart. My son helped me with PowerPoint, and he said we should have said the ABCs of Cardwell RSI, because it's very different. Even Wells, when I sent this chart to Wells, I drew this having a cup of coffee. And then I went back and I said, well, there's about 26 points. We'll call it the ABCs of RSI. Bullish divergence. These points A and C, lower price, higher RSI at C than it was at A. That's not bullish. It's overextensions. The only bullish reversals you see take place is, I will show you today, breaking through range rules, going to higher levels, pulling back, and creating in here E and G. The RSI went lower, but the price was at 148 versus 142. So it got more oversold at G than it was at E. If you take the difference, 6 points, and add it to F, 155 should go to 161. Here it went to 159, didn't get to 161, but it was higher at H than it was at F. So when it pulled back to 157 at I, and then went up to 163. So it achieved that target of 155 plus the difference of 6. I call them positive reversals. It's a target. Until it closes above that target, it's just a resistance point in the future. Here it closed above it, sold off, and what did it do? Another positive reversal, 159 versus 157. So that's only 2 points, but it said 165. He added it to the 163, and it went all the way to 170. So I didn't put the scaling on yet for the where it is on the RSI. I just want you to look at the patterns. This is a bullish divergence. This and this are positive reversals. Now, it makes a momentum high, sells off from L to M, then goes up and makes a higher close. Now we're the opposite of the bull divergence, and we're seeing a bear divergence. Then we're seeing another one where it sells off to 169 at O versus M. That's 4 points. Now what happens here is it rallies to 175. Maybe during the day got to 176, 177. but it should have closed above 178, and it didn't. So when it doesn't close above it and comes back down, it could be. I looked at it when I was doing these charts with graph paper. I said, well, that's strange. And then I checked the high low for the day, and it barely got above it and then sold off by the end of the day. So that's a failed buy signal. The best sell signals are failed buy signals. The best buy signals are failed sell signals. So we'll get to the negatives over here in the red. And if you notice, I made the positive reversals in a green line. So it's like go, and then the red line for the negatives, stop. Keep it simple. When a signal fails, when it fails to achieve and close above that target, then it says it could be changing. It did. It came down to Q and up to 170 and then down to 157 lower. So it met resistance at that price target again, almost equal to the 169. It went to 170. If it had stopped at 169, it would have said this bottom became that top. That's an old school trading rule. What was resistance, when it breaks through and goes up, usually comes back down to find support. It's like these positive reversals. Once they're achieved, they become a support level. So in the future, when it sells off again, if it stays above that, the trend is still up. I draw a horizontal line right across the screen at whatever my target is. So when it clears it, I know it's cleared and closed above it. Or in the case of a negative, that it's gone below the target and staying below it is resistance. So when we come down to S, we went below Q at 163. We come back up. Look at the difference between R and T. Higher RSI value, but a lower price. That's not a bearish divergence. That is a negative reversal. So those 2 points get subtracted off of S at 157. Here went down and closed, it rallied back to 166 at V, down to W, and went under the letter S. It rallies again, goes to X at 163, 166, V minus X, 3 points under 155, because that's the lowest close we've had. Rallies to 158, and then it eventually sold off and went through the 150 level. But it was a chart that I drew having a cup of coffee one day on a sheet of paper and just said, well, look at all these. We could just put points on them, prices, and there's the move up. Here's the bull divergence. When you start with the bull divergence, the first positive says your bottom is probably in. If it doesn't go below 125, it's probably in. But your stop doesn't have to be that far out. I do a lot of price analysis. Some people call them pivot points or swing points. And I know with the pivot points and the swing points, everybody's formulas are different. I've learned some things from friends in Chicago that invited me on the trading floor for an hour and got to see everything and got talking to different day traders. But most people use high plus low plus close added together divided by 3 to get your center pivot point. I use high plus low plus 2 times the close because most indicators are based on closing price. And I do them daily, weekly, monthly, quarterly. And it's interesting because, you know, what Greg was talking about in the different indexes, you can do them on indexes, on the Dow, the S&P, private individual stocks, gold, whatever. Numbers rule the universe. I always say numbers and patterns. Numbers being specific prices, moving average values, trading band values, I've even taken my work years ago and shared it with John Bollinger. I put RSIs, put Bollinger Bands on my RSIs. And it's very helpful. You take a look at it. But let's do a negative. Here's 170 at R. Sell off, back, take the 2 points to 155. And then we got another one that told us below 154. So when I see a bullish divergence followed by a positive, a trend should be up. When I see a bearish divergence followed by negatives, the trend should be reversing and we can set targets on the way down. Where the RSI is what I called my range rules. So let's start there real quick. Number one, I don't normally use the word overbought. A market is truly not overbought. I use overextension, and bearish divergences are not sell signals. Bearish divergences are just overextensions, and it's a little exhausted maybe, and the market needs to correct a bit. It's not really truly overbought until you start seeing negatives, because you'll notice, I'll show you, the range has shifted. Everybody thinks, you know, I've spoken at CompuTrack, Traders Expo, money shows, and I have people that say, I was going to come to your session, hear your presentation, but really I've used the RSI for about 6 months now, and you sell 70, you buy 30, and you just look for bullish and bearish divergences. And then standing there with one of my course students who starts smiling and laughing, and the guy will look at him and say, what are you laughing about? He said, be careful. That's all I can tell you. Be careful. It's not 70 and 30. It's not just divergence. There's a lot more that you don't know. And one of my favorite expressions, Bruce Fraser is always kidding me about some of the expressions I come out. He calls them Drewisms, Andrewisms. You don't know what you don't know until you need to know it. Now think about that. It goes up, you look at a bearish divergence, say the market's reverse, getting ready to reverse. No, a lot of people are going to take profits. It's going to sell off into a positive reversal and go higher. It's just a short-term overextension. So I tend not to use the terms oversold or overbought. If you look at these parameters, it goes between 0 and 100. Normal range. The bull range is between 80 and 40. The bear range, the RSI is usually between 60 and 20. And so the whole range is really 80 and 20. This midpoint, the 50 is the middle of the line and center of the range. That's all. I've seen some positive reversals show up after a bearish divergence where it only pulled back to the 65 level and then it turned around and went through 70, went through 75 and 80. And heard people say, oh, it's got to be oversold or overbought. I remember with my hand charts in 1978, seeing the bottom in gold and silver, and it started showing positives, and people were talking about, oh, gold can't go to 400. I said, I've got targets at 550 and 600 off of weekly charts, monthly charts. Time frames don't matter. You can use RSI the way we do, and 5-minute chart, monthly, daily, quarterly. Same thing with the pivot points. So the 50 level is just the middle of the chart. All right, here's something. Everybody calls me, I love your range rules. If the RSI activity for the most part is between 80 and 40, it should be in an uptrend. When it breaks at 20 is the bottom, 60 is the top, same 40 points. All I did with the range rules is 70 and 30. People are by nature bullish. They understand upside more than they understand downside. So they get a little more euphoric when it gets above 70 and drives it to 80. I've seen some markets on daily charts hit 92, 95, sell off to 70 and stay above 70. It's like a basketball game where everybody's tapping the ball back up towards the basket. When that range shifts and the RSI drops below the 40 level, And then it rallies and it can't get much above 60. And it's not chiseled in stone. It may go to 61.8 and hit a nice Fibonacci number. It may go to 62.50 or 63 and then snap right back. And Greg and I were talking about this yesterday, and I put moving averages on the RSI. A simple 9 of the RSI 14. I never changed the formula. But if I see that range shift, and I think that's we're going to have some action in the next couple of weeks because I'm starting to see it stall. And even though it went to 70, we still haven't taken out the highs from February. So I think we're getting ready to shift into that chain, into that downtrend range. When it's in a downtrend on the right-hand side, when it's in a downtrend and it breaks through 60 and then pulls back maybe to 55, and shows one of those positive reversal patterns, it's probably going to go to 70 or 80. So just remember, these are my range rules: bull range, bear range, 80, 40, 60, 20. If it's trading between 60 and 40, leave it alone, because it's just going to wear your patience out. You're going to get frustrated. Let the markets show you what they want to do, not what you want them to do. So if you're in that 60-20 and you start to go up and you break above 60 and you pull back, you might see a positive reversal in around this 40 level that says you're going to go even higher. Okay. I put moving averages on it. I've also just taken the RSI line, short term turning up if the RSI gets back above 45 and rising, 2 intermediates turning up. Intermediate to long terms turning up when it gets through 55 and starts that upside acceleration. Because when you do the moving average, put a 9-period simple moving average on RSI and it goes through 60, not only is the range shifting to up for the RSI daily itself or hourly, but the moving average is shifting up. And that's the start of your initial acceleration to the upside. The inverse for the downside, short term turning down, intermediate turn. This is, it could be the RSI, which is not going to be that smooth. I haven't seen a market in 40 years that's that smooth. But these range rules, when you apply the moving averages to them, you'll see where they're starting to accelerate. I'll show you a couple examples where the RSI went down, never got below 40, and the trend stayed up. It's just patience. And I think I learned patience. I always tell people I can teach you my RSI methodology and my approach, but I cannot teach you patience, discipline. That's something you have to learn and be able to handle yourself. Risk management, discipline. It's a game. And profits and losses are how they keep score. Okay, let's go to divergence and signal count, momentum highs, momentum lows. There's an X point, then either a bullish or bearish short-term signal. This 2 to 5 is how many periods apart that bearish or bullish divergence is, or the positive or negative reversal is, whether it's going to be a short-term, an intermediate, or long-term. Okay, pretty much you guys are technicians. You'd understand bullish divergence. If 100 is X point, and then this goes up on 2 periods, and it sells off to 99. Lower price, higher RSI, X, 1, 2. It's a tight signal. Same thing here. Bearish divergence has an X point, 100, sells off, comes back up to a higher close in the price, 103, but not the RSI does not go to a new high. That'd be X12. There's different combinations, could go down for 2 days and then a big move up and make it 3 periods apart. But less than 5. The chart on the Dow Jones, I think it was monthly or weekly, showed a clean 5. Here's your bearish divergence at X, 121, 123. So we'll call it bearish divergence. Now look to the right of that, 123 and 121. It's like that chart on the ABC's chart. RSI went higher, but price didn't. So take the difference and subtract it to give you targets. Bullish divergence, 117, lower left, 115, market goes up. Look to the right, positive reversal, 115 goes to 119, then down to 118, more overextended to the downside, lower RSI, higher price. Take the difference. And what I like to do is take the difference and add it to the first point, 119, to get a short-term target, and then add it to the close left of that. Say it's going to 123. You know, I'm flying through this, and then we're back to this chart. But that's the basic of the patterns and the range rules. Okay, let's see if we can, we should still be on. Can you see that chart? Greg?
Yes, I can. Yeah.
Okay, everybody sees it. I had made a note, and I really enjoyed your presentation. First time I guess I learned more. PPO, your PPO oscillator. That was interesting. I'd never seen that before. All right, but I marked here, I wanted to look at what you, I think one of the first ones you did was the XLY.
That's true, yeah. XLY, XLK, and XLC.
Right, LP, consumer staples.
That's P as in Papa. I was doing,
right.
Yeah.
Yeah, I know. I had written them all down, and then the transportation, my brother and father were tractor trailer drivers. The consumer discretionary, XLY. Now, if you think about it, and not meant as disrespect, that's money that people have outside of paying their bills. Okay, they're the extras you want out of life. Okay. And down here at the bottom, there's a bar chart. Do it this way. Bar and RSI. That one at the bottom, and I'll come back and share it with you. That's my CFG. That's my own personal RSI. This top chart is, just a second. I'll make sure I got the right one here. Here's what I told you before about Bollinger Bands. You can put Bollinger Bands on RSI. There's Bollinger Bands on consumer discretionary. Here it is on RSI, and the bottom is my CFG, which is my personal RSI. But I wanted to get just a chart with bars and, where is it? I thought it was here, bar and RSI. Let me just check something, the edit. Because these are 9 and 45 period moving it. It's supposed to be 45. I will use the other one. Yeah, let's just use my CFG as well. This blue line is a number where I took moving averages. That's why I said price, momentum, time, sentiment. The RSI is the only indicator that I've ever seen that can give you price, momentum, time. You can figure time cycles, how far apart, and sentiment tool. Basically, RSI is just, it's momentum analysis, but it's saying where are most traders thinking. And once you learn range rules, that helps. Once you learn using a 9 and a 45 on your RSI, that will help you. So we made a peak back in September. And that was a high. Then RSI got up to 82. This is a daily RSI. If you look at the weekly for early September, where is September? Here's the end of August. And that peak was only 72 on a weekly. Now, if you start to count how many days apart was it? If this is X, 1, 2, 3, 4, 5, it went to 6 weeks. Well, when I was learning other things, I learned a little bit from Gann. Don't consider myself an expert in Gann, Elliott, or candlesticks, or even Bruce with the Wyckoff. I've learned about Wyckoff through finding RSI patterns and see what the Wyckoff analysis is. But this is 6 weeks apart. One of the things I learned about Gann is you're going to make a high and a low during the year. And then you're going to make retracements and things like that. But one of the rules that he shared was taking the high minus the low and dividing the range by 8 to get 12.5% retracements. But he also talked about time cycles. If there's 52 weeks in a year, there's 2 26-week cycles, there's 4 13-week cycles, and there are 8 6.5-week cycles. And what we were just talking about, how many days? I heard a big bang here. I'm the only one here, unless they're moving furniture upstairs. But the time cycles, I think you're going to find them helpful. Look for a low, okay, and then count 4 weeks, then count 6.5 weeks, then count 9 and 13, because 13 is 1/4 of a year, like the equinox or the seasonal changes. But price, time, here's your sentiment numbers. We can see we got up to, like I said, 72, and last Thursday, or a week ago, 2 weeks ago, this is yesterday, 2 weeks ago, it only got up to 70. And one of your charts, Greg, you showed the oscillator had gotten above zero, sold off, and then came back. You couldn't get back above zero.
Yes.
That's the same thing as the RSI going up near 80, selling off to 65 and not being able to get back above 70 or 68.
Exactly. Same ideas. Yeah.
Yeah. So what we talked about yesterday. All right. That's, this is still consumers, right? Yeah. I even looked at the monthly on it. Now, once you draw a bear divergence, here's one. This is on monthly. You see where we've been talking about it running out of little gas here and losing momentum? Here it went down, it bounced off to 40. So that shakeout did not go below 40. And also with the moving averages, they went above 70 a while back. And you can see the 9 was above what I call my number. I teach that too. But today is just, think of this as like 9 and 45. But when that 9 of RSI crossed was March of 2011. And the 9 of RSI stayed above 60. Remember what I said about range rules? They get up and sometimes only come to 60. And this trend just kept going and going and going. But lately, it's crossed the 60 level. So I'm watching monthly, weekly, and now daily. The daily on that sell-off from September, the RSI went down, the 9-period moving average went down, and when it came back up, the 9 came back up and came above 60. But once it got above 60, and we had a shakeout again. So I think we're getting ready for a little exciting action between now and the end of the year. I mean, there's so much going on with COVID and the election, the trade deal. I haven't heard much about the trade deal lately. What was the other one you had there? Transportation. But what I was noticing about the consumer discretionary is I thought, if people have money, they're going to spend it, they're going to pay their bills, and they're going to spend it on what they want. So it's not necessarily a need, it's a want. But when this starts to slow down, and basically people that have that extra spendable cash, if they start to back away, over the years, I've noticed that consumer discretionary will turn down before the market does. So it's a good leader. The other thing it does is in the financials. Usually we'll see the financials top out before the stock market does. So there's a lot of cross currents going on with the different markets. But if you look at, what's it going to say, the consumer staples, the XLP, the transportation index is what I was looking at, because you were a little nervous, concerned. If you're not concerned about the way these markets are moving, then you're not doing your chart work, because there's a lot that's happening under, like a duck. You see it going across the water. It looks like it's smooth and cool, but he's paddling like hell underneath. Here's the transports. You had bearish divergences up here. They are not a reversal signal. It's just an extension. You talk about drawing a line when we were talking about positives. These positives can be short term. This closed 97.45. This closed 96.96. Right into the 45 of RSI and turned up. The 9 was up. The 9 was above the number, or the 45 up here. We got a little bearish divergence here, 11.322 and 11.451. And people were saying, oh, that's the end of the market. Well, we'll see, because it came down to 11,080 and stayed above 10,865 and 11,080. So higher price, lower RSI. It also came back down to what were tops, where tops become bottoms. You can look at the points going back. If we go back from 11,080, here's 9,700 basically. That's a lot of points. I looked at this yesterday. It's interesting, the transportation. If I connect the line, and I'll draw lines on my bar charts based on positive and negative reversals. We'll come from right in here through this close and roughly come back to it. Had a lot of problems with it, getting back above it. And I kind of know my finger slipped off the screen, off the mouse. But you can draw trend lines on your bar charts based on key positive and negatives. There's the close. And this date, where's the 11,080? Right in here, the second low. You see how it went below it, went sideways, then went up again. But the RSI really only came down to 49 to 50. It never even got down to 40. But this latest rally got back above 60, but it didn't get to 70. And it also pretty much topped out with what's back here with the RSI point, because it challenged this, went to another new high. And that second high, market sold off a little bit, gained its footing, and went back up. Now we're doing it again. So I'm thinking a lot of these markets, and I'm not, I've got students and clients in 28 countries. So they got me looking at the Indian markets, China, everywhere. And a lot of them look very toppy. The DAX used to be my favorite because it seemed to be the world leader. But even the DAX looks toppy. You look at weekly and monthly. Look at the DAX here. It's not really gotten above 60. And it's basically been sideways for months. So sideways is sometimes good because it's the market resting before it makes the next big move. But sometimes it's bulls and bears fighting. And if they're going to be street fighting in here, I don't want to be involved in something that's going to be choppy. That's daily. Look at weekly. Here's the February sell-off. Look what happened on the weekly. We haven't even tagged 60 yet, 59.9. I had a client call. He said, Andrew, you better sharpen your pencils. It's 59.9, not 60. I said, well, it might go to 61. Who knows? One little trick I want to share with you now. It's not RSI related. It's price related. See this close here with that bar chart? Find a close where the next day, the next period, the high is not, can be equal to, but not greater than the previous close, okay? And reverse it for the bottom. You'll see down here. Next day it opened higher, traded down, but it never went below the previous close. So that becomes just a support level off a bar chart. Don't have to be a rocket scientist to draw lines. That's why people laugh all day. They said, all you do is color and draw lines all day. I said, oh, it's fun. Now, in this case, where that topped out, as I said, I draw it all the way across the page. And look at this. Now, if we drop to a daily, you'll see that same line. And if I can pull it down, there you go. There's that same line. So you got that one and you got the one we drew at the bottom. You can even look at monthly. Here's your range. I hope we're not stuck in this for a while because it's time to go to the beach or just forget about this chart. But look how it never really got above 60. Then it went above 60, made the highs, made a X, 1, 2, 3 period bear divergence. So here's the bear divergence of a few days, or in this case, a few months. And then you have one longer term that it's also still below. So when I drew this one all the way across the page and then I saw like a 4 period and it sold off, I was very cautious and patient to see if it came back above 60, which it hasn't. And I think Europe's going to have their own problems. London. Let's see, London. Come on, computer. I haven't worn you out yet. Don't crash on me. Okay, that's good, computer. Look at London monthly. You know, and people ask me all the time, with stuff you know in RSI, why don't you just trade 5-minute charts? 5s and 10s and 30 minutes and day trade. I said, because I have a life. I enjoy life. I enjoy the beach. I enjoy playing golf. I said, but I can make more and do better just taking a position in a market. There's monthly. Here's weekly. Here's 60 way up here. This is almost into like a little wedge. I think it's going to break down. If it breaks 40 again, then I think we're going to be seeing that one be one of the first ones to top out. Here's in a nice, what's the R doing? Okay, somebody get a calculator. 60, we'll round this off, 6,300 and 6,280. It was actually only about 20 points off of that low as a target for a negative, right? 20 points says 58.97. So it should go roughly to 58.50. And we went to 58.62 and then closed below 5,800, right at 5,800. Now we got another one, more that are showing up. You can go to 240, all time frames. Come on, fill in. I know we're getting short on time. There's a couple other things I want to share. I think everybody's on their computers today. I've noticed when the markets get active, the internet slows down. And I had mine internet go down totally for 2 days. thought of the days I was back doing charts by hand. I said, well, I just got to wait for the close. No, I got to wait for the internet to come back up. Let's take a look at, how about dollar? I'm still negative the dollar. Got to go. It's a dollar index. Here's the 240.
Oh, I hope you're right on negative the dollar.
Well, I've been negative the dollar. Okay. I've been negative the dollar recently from 101.5. And before that, back in when I taught one of my classes, I think it was the Edge course I taught in 2002, I had sinusitis, bronchitis, and laryngitis. And yet I was still able to do it. A friend of mine was a disc jockey, and he said, drink lemon water, squeeze lemons and ice water. But the dollar index was up around 116, and I was telling people it was going under 95, and I got hate mail. I got people that were giving me hate mail. If I talk negative about the stock market, I get hate mail. Look at all this back here where, all right, there's the low from 18 at around 90. Back here is when I taught, the arrow. Back here is when I taught the course, my advanced course. Go to monthly. Zoom out. All right, this was 2001, 2002. This was March 29th of 2002. My birthday was the 26th. And I told everybody in the class, that's when I was teaching live. I told everybody in the class that weekend, it's my birthday, let's have a party. I'm going to give you a trade. Short the dollar, buy gold, buy currency, buy some commodities, because this dollar is going to fall out of bed. And it did. All the way down 6 years. Look at the RSI work. You had divergence. You had that 9 of RSI go below the 60 and turn down. Then it went below 40 right here, and it started to accelerate all the way down. And the RSI got all the way down to a 20. So now, let's look at weekly. Oh, Greg, I still think two things. I think gold's going to eventually get up over 2,400, 2,500, and eventually test 3,000. Silver, I think, can go. In March of this year, I said gold was going to 2,000 and silver was going to at least 20. And before it even got to 20, I said, it's not even going to stop. And I've been telling people $20 on silver, you're looking in the rear view mirror, because I think it can go to 35 or 40. This dollar has got all the, well, let's finish this. It went down. RSI got down to 25. So it went under the 30 level. Then it made a divergence with an RSI of 28. And we came back up. We tried to get above 60. And we got back and forth. But this is where you saw all the positives start with these closes. Once it went up, there's the 9 going above 60. Here is 94.01, 94.21. It's one of the first positives you saw. But see how you had the moving averages of RSI turn up before then? Then it got above 60. Then you got bearish divergence. When you see bearish divergence show up on a chart, you're usually going to see positives, because the two got that chart I showed with the 4 squares. You get a bullish divergence followed by a negative, then you're going to see lower levels. If you get a bullish divergence followed by positive, it's confirming that that bullish divergence is real. But you had positives in here, then you had another one from here over to here, then you had another one in here. Look at the price action. Each one, the higher price, lower RSI than before. Now we hit a peak up here, which was back in March. And sometimes you'll make an RSI will make a peak in momentum, but it doesn't make a bearish divergence. And people say, well, there's no bearish divergence. It must still be up. And then they hold on to the position and they're getting nailed. You learn more from your losses than you do your wins. All right, let's go back. Okay, this is daily now. So you hope, well, there's your bearish divergence. Here's your range shift. Started down, could not get back above 60. And no, I'm running quick on time. We got 5 minutes left. Never went back above 60. Then went down, went under 40. And look where that 9 crossed. The RSI crossed. That 9 RSI moving average crossing says you're going to get that acceleration to the downside. Well, be patient. Look for sell signal. These bottoms became tops. This bottom became a top, which I drew that line all the way across, and recently came right up to it. And look, you had a long-term negative here. Long-term. 96.31 and 94.58. Roughly 200 points. Off of the low close, which is here. It's 90, around 92. I think it's going to 90 or 88. And it's going to affect other currencies, gold, silver, crude oil. Crude oil is going to be flying on its own this year. But I'm expecting in February of this year, February, March, I started talking about an inflationary recession. And I think the inflation is starting to come because one of the things that I do watch is the CRB index. And it's already, let's see, where's CRB? Here's your daily CRB index. Here's your weekly. I think that started to trend change and been up for a while. And the grains, cotton, I'm expecting coffee to at least double in the next year, if not more. Okay, that's weekly. And if we go to monthly, you're going to be breaking this long-term downtrend in commodity prices. And I said, you know, we're not all analysts, but we can draw a line. And I didn't draw a tag in this one. But I always tell people with my positive and negatives, if you can add 1 and 1 and subtract 1 from another and get a difference and add it to, all you got to learn how to do is add and subtract. All right, just roughly. Stayed under, come down near that low. We're starting to make some noise with the RSI starting to rally back, trying to get back above 60 on the monthlies. On the weekly, the RSI is already going above 60. The SMA 9 of RSI 14 is going above 60. And the daily, the 9 went through 60 back here for the first time back in May. And it's been steadily rising since. And then you have that positive that I marked right here. So I hope, I know time's running out. I just wanted to mention that I just had the, 30th anniversary. I started teaching my coursework in '89. My website address, I think Greg has it, and we can put it in. I've done some things with Bruce Fraser on power charting, so occasionally I'll show up on stockcharts.com. But if you just take Cardwell RSI Edge, EDGE, like I did on the PowerPoint here, .com, that's my website. Since we're all professionals, you know, one thing I want to do is I'm not 45 anymore. I'm not even 55 anymore. I hit the 6'6" this year, and I'm not planning on doing many public appearances except private work with like Greg or Bruce or Stephen Bigelow or somebody. So when you go to the website, you'll see all the course information. This is not a sales pitch. I just want to help people because I've got some students over the years who have taken my work that are now managing money. I'm talking about 10 and $20 million funds, still using the RSI. They send me charts. I do a weekly video with my private clients who have both courses. But if you're interested, go to the website, check it out. There's some articles on there. One of them was called Today's Technicals Write Tomorrow's Headlines. Learn to see how the market shows you what it wants to do before it does it, basically. And then you see it in the headlines and everybody rushes in and it puts your position higher. My direct email, trader011@msn.com. And I do have Skype for anybody that wants to join me on Skype. And that's just Andrew RSI, which a client suggested for my Skype address. Another client suggested the Skype address, Andrew RSI, and a couple of them got together and they said, you should name your website Cardwell RSI Edge, because the way you teach RSI is totally different. And some people have tried to pirate my work, and then somebody will call me and say, oh, I heard that on somebody else's website. He did a webinar. I said, yeah, he was somebody got a hold of a pirated copy. So if you got that, then you can call him when you have questions. And then they eventually call me and I say, well, it's different, huh? He said, yeah. I said, well, I've been doing it for 40. He maybe has been doing it for 6 months. I said, there's a lot that you learn through experience. I said, I've seen a lot, like the peak in 87 in the stock market before the crash and dot-com bubble, and the top we made at 14,000. Just be careful because Greg's a little nervous. Well, I was getting a little nervous myself too, because they don't always ring bells at the top. It's the subtleties that you have to see. You have to look at and say, why did it not go up? Or what do I see? What do I need to see to have it turn down? And there's some things I'm seeing, and some of this that I've shared with you this morning. Use my email address. Give me a call on Skype. I want to help, because when I was teaching a class, I was trying to help students, but I'm saying when I was teaching and coaching, my son's 32, and I coached Little League from the time he was 6 or 7 till he was 12 or 13. I taught the kids, the better you learn to play a game, the more fun you're going to have in it, the more you're going to get out of it, and more it's going to be like your happy place because it's slow motion. And my happy place is when I'm going through charts, if it's not clear, I turn the page. If it starts to draw my attention, I say, well, let me check my pivot points. Let me check the range rules. Where's the art? Everything I've learned in 40 years. And then when somebody calls and says, but Elliott wave, I said, I'm sorry. There should not be negative reversals in an uptrend. So you're not in wave 3 up. I said, I don't know what kind of wave it is, whatever, call an Elliott guy. But my work and the RSI itself can stand as an independent trading model or a complement to whatever you've been doing. Because I take on a new student, I don't tell them, forget Elliott wave, forget candlesticks. I said, I got something that's going to improve your Elliott wave. Something that's going to help you read the candlesticks better.
Yeah, Andrew, we got to wrap it up because we got the next speaker. We need to go here, but thank you very much for presenting. You were awesome. Really do.
I'm going to stay on because you said, I think who's coming on next? Tom?
Dwight Galusha is coming on, and he's got lots of short-term setups that he uses. Well, he uses everything from monthly, weekly, and daily charts, but Dwight does a lot of stuff with volatility squeezes, and really, I think you'll find that work quite compelling. So
I'm going to get another cup of coffee and come back. So.
Sounds good. Stay with us.
All right, what do I got to do for you now?
Okay, so now I think you have to make me presenter. So under the participants list, so down at the bottom, it says participants. Click on that button.
Okay.
And then you should see Greg Schnell. and you just click on me and it says more, and then you say make presenter or make host, I think.
Make host.
Yeah.
All right, folks, if you need me, get in touch with me direct, or Greg will have my information. I really enjoyed it, and I hope it gave you a whole different perspective on RSI.
It definitely does. Thank you very much, Andrew.
Make you host, and I'm going to stay on.
So.